Thank you all very much for logging in, and I'm very excited about being able to do this presentation. Just to start, after having spent many years on Wall Street, and kind of growing up in the business and being a woman in the business and whatever, it became very apparent to me how important it is to educate women and have us all very informed. That being said, one of my missions as an advisor is to be transparent and open and really, as I had said, educate women on just certain guidelines on the investment process, retirement process, etc. Okay, so the name of the presentation is Inform Women Know More. And again, this has been created with marketing and input from the advisors at AXA Advisors. Basically, I'm just going to start talking about the unique strengths of women. I mean, there are more women now than ever going to college, getting degrees, becoming professionals, really going out on our own. Um, these statistics are from 2014, so they may be a little bit different, but basically, 63% of women are accountants and auditors. And by 2017, which is now, women's income globally is estimated to jump by almost 6 trillion. And I would say that we were probably there. And sadly enough, well, women earn the 52% of bachelor's degrees and 56% of master's degrees. So we probably have more graduates than men. And as I started to say, sadly enough, we are not paid as well, which we will see. And again, our graduation rates are raising, our earnings potential is rising. 51.5% of management and professional roles are held by women. Nearly 39% of wives earn more than their husbands in 2013, and I would say that the gap is probably widening for women, and it's probably somewhere in the 40s. And we basically control over half of the U.S. personal wealth, estimated at 14 trillion, and we really inherit a lot of the intergenerational wealth transfer, and we will continue to do so over the next 40 years. And a lot of it is because we outlive men, we are the caretakers of our parents, and that type of thing. So basically, we really have a strengthening role in the economy in terms of employment, education, and I really truly believe this will continue to increase. Women tend to be more concerned about their financial future. Some of our challenges, as I had mentioned, we earn less money over our lifetime, reducing our ability to save. We still only earn about 80% of what a man earns in the same job. And coming from a working environment for a long time, it's always been this case, and it's really just coming to light now. And unfortunately, it's not changing quickly enough. And we can all hope that as we continue to make strides in the workforce, that will grow. Women over our lifetime work an average of 12 years less than men. And I'm not really sure why this is, but I'm wondering if some of it has to do because of our caretaking capabilities, or because we have babies when we're younger and take time off from the workforce to raise families, and any other considerations. And the third point, which is interesting, it says women are expected to live 80 years from birth, outliving their male counterparts for more than 5 years. And as we can all witness, we are living to be older and older. And I think we're living a lot older than 80. And I know, I'm sure many of us in our daily lives run into people in their 80s that are still vibrant and running around and doing things, and we can all hope to be that healthy and have that longevity. And the crux of this is really knowledge is power. So now that we are working longer, living longer, making more money, more educated, how are we going to prepare for the future? How are we going to plan for our financial well-being? How are we going to, pay our bills? How do we plan so we don't outlive our money, which is a very big concern for retirees? So we talk about knowledge and guidance. Women who use financial advisors are twice as likely as those who don't feel on track or ahead of schedule in retirement planning. So I personally can say that I do work with a lot of women. I work with a lot of couples, and it's always the women that are more like, all right, let's sit down and go through the numbers. What do we have? They tend to be much more, because of, I think it's our DNA, we tend to be much more careful investors. And from that respect, you know, I need to empower women to feel more confident, more willing to take risk in terms of, so if I talk to somebody and they have, X amount of dollars sitting in cash, it's like, okay, we can invest some of that over time and I will demonstrate that. And basically, we want to teach to teach you all about the different financial tools. So what is a stock? What is a bond? What is an annuity? What is an ETF, exchange traded fund? How do these all work in conjunction? How do fees work? What are embedded fees? Why would you invest in certain vehicles and not others? So this is something that I think it's very important for us to be educated on. So the mantra is start now and start simple. So why not today? So I really like to show this because it shows compounding of money. So basically what this means is if you put X amount of dollars into whether it's a retirement savings account or just a regular investment account, the younger you are, the faster it will grow over time. But I always tell people to put it in regularly. So we call this dollar cost averaging. So the reason why this is such a powerful tool is because it gives people a discipline to invest and save money over time. So one of the examples I like to use is sometimes people will say, well, if I put this money in now, the market is so high. But if you put money in every single month and compound it, on some months you're investing when the market is high, and on some months you're investing when the market's down, you're investing when it's low. And over time, that money will grow. So we're assuming a 7% rate of return on these numbers. So basically, it's saying that at the age of 25, you have 40 years until you're 65 years old. And if you put in $189 a month, your contribution is $90,000, and it goes through at 7% a year, your earnings, and that's where you get to $500,000. But if you go to the other end of the spectrum at the age of 50 to get a $500,000, you only have 15 years to invest. So it's showing you that your monthly contribution must be a lot higher in order to get to that number. So this is really talks about the value of saving money over a period of time. Oh, oh, there we go. Okay. And then the other strategy I talk about as an advisor is it's a strategy versus a product. So it's one thing if you call a mutual fund company or just call somebody and say, oh, I want to put X amount of dollars in a mutual fund. I mean, that's great. But really, the way strategy works is it's really building a plan. So it's being able to sit down and say, what are your goals? What are your needs? What's your risk? How do you, how do you foresee your retirement, or how do you foresee your plans in the near future? Are you saving to buy a house? Do you want to, do this? What's your budget? What's your tax? So it's really kind of building a little strategy and a plan to see what the need is. And then the second thing is we create a properly allocated portfolio. So what this means is based on your risk, meaning do you want to buy more stocks? Are you more comfortable in cash? What's your time and your time horizon? How are we going to create a portfolio an asset allocation portfolio with different types of investment vehicles in it to help you get to your goal. And then the bottom is, and then we're going to pick the products. So we're going to say, okay, I want to buy a growth mutual fund, and then we'll pick the specific fund, or I want to buy, this certain type of bond, or sometimes people will need, for risk management and insurance vehicle, I'm having a baby, or I have this, and we'll do, take a component of the monthly income to put it into an insurance policy or a long-term care policy. So that's pretty much how we roll here in the advisory space at AXA. The other thing, and I sort of touched on this before, as we talk about your financial goals are in three buckets: your short, intermediate, and your long. So it's really, defining, your how much liquidity do you need? How are we going to construct this portfolio? What are the tax issues? So we have to look at the goals in order to create a very diversified strategy. So, okay, if my goal is 3 years and under, so obviously you're going to need more cash and less risky. If it's intermediate goal in 3 to 10 years, there's a different balance. And if your goal is 10 years out, you can afford to take more risk because the time, the time value of money in the investment, there studies, and it really shows how certain investments grow over time. So in a short-term need, if there's a downturn in the market, or if there's a need for a certain amount of liquidity, that's not going to work for you. But if you have a much longer time horizon, you can afford to think a little more long-term and invest and take a little bit more risk. So here we have Financial Planning 101. So again, this, I'm not going to spend a lot of time here, but this is basically taking the concepts, building the investment plan, and it changes over time. So it's basically doing a review. So, we will select products for, as we said, risk and tax, liquidity, do the portfolio, and, try to get you to your goals. But once we do this, there's a review. It's usually an annual review, sometimes twice a year. It depends on the need and what the changes are. So once the plan is put in place, I always say, I always say that, I give you guidance in terms of what to do, and I put the information out. It's up to the client to choose, and then I'll implement it. And then over time, I'll sort of take a role and say, okay, you like this for this. And then we review and reallocate over time. And there's the thing: be empowered, take action. Don't be afraid. I talk to a lot of people, and they don't, it's like, yeah, I need to do something in this, and they just don't do anything because it's like analysis paralysis. I'm afraid, or, it's like nobody wants to talk about it when they're sick. People don't like to talk about money. It hurts. It's painful. So you have to kind of get over that and say, okay, I'm going to sit down and I'm going to do this. So, start today. I encourage everybody to work with a financial professional that you trust and who understands you. This is a interactive relationship, and trust is critical. So, and an example, if I'm working with someone and I get the sense they don't trust me, I have to ask that question. And, do you trust me to work with you on this plan? And if I'm getting a negative vibe, then it's not going to be a good relationship, because they're always going to question that. So I really encourage to do due diligence on that. The other thing is cash flow. Know your ins and outs. What's your available cash? What's your budget? People hate doing a budget because it hurts, but it's important, because you have to really look at this as a whole. So when investing, we consider tax deferred retirement accounts, which are 401ks and IRA accounts, and those grow money on a tax deferred basis, so you don't pay taxes annually. It increased, so you can take more risk and do it longer term. And then again, it's what's taxable, what's non-taxable. The other thing that we do for retirement and income streams is we will sometimes use annuities, if it fits, to defer taxes or to create streams of income. Where do you go from here? do it yourself. Sit down, take all those papers out of your drawer and start looking at them. Work with others, ask people, ask questions, read things. Work with us, whether it's, me, another professional, but don't procrastinate. This is really important. And the sooner you get yourself on a path for doing this, the better off you are. And I will say this also from experience. Once people sit down and get the plan in place, get the investments in place, and there's paperwork and a lot to be done, they always feel so much better because it's like, wow, I finally have a plan in place. And that's it. I hope I didn't go too quickly. I hope I covered enough ground and made this somewhat comprehensive. And I want to thank you all for listening. Um, I have my email and my phone number, and you are all welcome to email me or call me with any questions, and I would be happy to speak with you. And there's no obligation, so thank you very much.
Thanks, Mindy. That was great. Again, I'll just say if you have a question now, you can email info@savvyladies.org or you can use the chat. And we had some questions come in during your presentation, and I'll start with the first one here. When you talk about compounding, is it the same for a savings account or is this just investments?
It's the same for a savings account. However, because interest rates are so low, you're not really getting a lot of money. You're not really making money on your cash. But for instance, if we were in a higher interest rate savings environment, yes, it would mean compounding for savings.
Okay, great, thanks. And another question about the compounding chart that you had is I'm 45 years old and I can't make the monthly contribution of about $950 that's recommended. What does this mean for me?
Is this if you're talking about a 401k plan? Um, well, okay. Well, this is an example of how to get to $5 million, but I think it's important to go through your budget and put a monthly contribution in that you're more comfortable with. What I do with people with a 401k, I figure out their tax rate. So what you put in goes against your income tax rate. So if you don't have 954 and maybe you have four something, we can figure out taxes and maybe raise it a little bit. But I think this is just an example, and I think anything is anything works you towards a goal of retirement savings.
Okay, thanks. Another question we have is you mentioned some different financial products. Can you give some examples of those?
Oh, wow. Well, that's a lot. In terms of investing, there are, as you probably, stocks, bonds, mutual funds, and exchange traded funds, which are known as ETFs. Mutual funds are called actively managed. So when you get a mutual fund, you are buying into a portfolio where somebody is actively managing stocks with a certain style. So it could be a technology fund, or it could be large growth stocks, which usually have a lot of healthcare and technology, or it could be a value fund, which would have more old world stocks, or it could be international, which has global companies on it, or it could be bonds. That's a mutual fund. So rather than buying individuals, you're able to buy a professionally managed portfolio with a certain style. So you would want to put different mutual funds in a portfolio. The other thing, exchange traded funds are also baskets of stocks. It's traded like a stock. It's a basket. It's something called an index, which is passive. So if like for uh, if you've heard of an S&P 500, it's stocks in the Standard & Poor's 500, and it's basic stocks, and an ETF will trade like a stock on an exchange, but it composes all those stocks, and it's not actively managed, but it mirrors what an index does. So, um, so on a basic investment portfolio, and I hope I'm not getting too complicated, but what I try to do with people is based on their style, put them in different asset classes, large growth, small growth, and maybe put some into mutual funds and some into ETFs if it makes more sense. And again, the goal is to build a portfolio with a lot of diversification. So if some markets go down, like I think today the market is down, like, there's a buffer because you have different types of investments in the portfolio. I hope that answers that question.
Okay. Yes, great. Thank you. Thanks for explaining all that. Another question here is, if you're in your 40s, how much should you have already saved in order to be on track for retirement?
Oh, that's a software question. So I'm not going to commit myself to answering that, but I would say whatever you save so far puts you on track. And if you haven't saved, I have met women in their 40s who have saved nothing. And my thing is just start now. So that's a hard thing. I don't know how much you have or where you are or whatever, but anytime is a good time to start, number one. And number two is anything you have puts you on track.
Okay. Okay. Another question is, why might someone choose actively managed funds over low-cost index funds or ETFs? I'm fully invested in passive funds, and I'm trying to understand the other perspective.
That's a great question, actually. It's interesting because indexes are very low cost, and they're great, and I use them a lot. I use index funds and I use index ETFs, and I know a lot of people who are portfolio managers for both ETFs and mutual funds, and I think they're great. We've been in a bull market now for, oh, I don't know, 8 years, 9 years, whatever you want to put on it, and I think for the I think indexes have done well because the markets have gone up. However, I like to use more actively managed mutual funds in conjunction with ETFs because I don't believe that index is always going to outperform active management. Um, I I also think that there are certain markets, well, I know that there are certain market sectors like emerging markets or oil and gas and certain things where actually active portfolio managers outperform indexers. Um, and the other thing is the fees are higher. Yes, this is true. I do believe you get what you pay for. And I work with a research group. LPL Financial is our investment platform. And what they do is they research funds daily on a daily basis, and we get a list of top performing funds, and we can evaluate them. The longer a manager has been managing a portfolio, the more money that's in it, the lower the cost is. And, so we'll look for track record, lower costs, market performance. But I think at a certain point in time and for certain market sectors, I like the diversification.
Okay, great. All right, well, those are the questions we have for now. I'll just
And
pull up
again,
your
I welcome
contact
anybody to
information.
call me for a more, this is hard, I can't see you, whatever, but I do welcome anybody to call me or email me, and I'm happy to have a much more in-depth conversation.
Okay, thank you. And for those of you who didn't have a chance to write it down, we'll send out Mindy's contact information for you. So I want to thank everyone for joining us today, and thank you so much, Mindy. It was an excellent presentation.
Thank you.
Thanks. Bye-bye.